Hello and welcome to the Investing Master Series. My name is James Boyd. Happy Tuesday morning to you. We'd like to welcome JP, GH, WW, BR, Silas D, and many others. Good morning to all of you. Now, just real quick, we got Connie Hill in the chat, also known as C Hill, and she's a fellow instructor. She taught the ETF class yesterday. Very interesting session, and so she taught that yesterday, and also why Barbara is out. She's covering many of Barbara's classes as well. So make sure you're aware of that. And we like to kind of joke that the two redheads are going to take you forward from here. Now, just real quick as we get started, remember that Connie and myself, we do post educational content on X. There's my handle. Connie will post her handle in the chat. Just real quick as we hop in. Remember, this class is on stocks and options. When we talk about options, remember that options carry a high level of risk and are not suitable for all investors. The information here is provided for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. The paper money software application is provided for educational purposes only. And also remember that investing involves risk, including loss of principal. And also remember, when we talk about examples, they are just that, short options. Whether we sell a call, like a covered call, you sell a put, the obligation to buy the shares at the strike price. Understand that we're talking about American style options. And what we need to really understand here is those could be assigned prior to expiration. What does that mean? Okay. And you should have an understanding of what that really means. We won't talk about REITs there, but that's just something that occasionally gets brought up. Now, also remember, I want to talk about just markets just briefly. I'm literally mean this 2-3 minutes. We're going to fast fire through those. We talked about those heavily yesterday. Second, I want to really talk about some current positions. In the margin account, there's no more money. We spent it all, okay, in doing examples, okay? In the IRA, we're almost close out of money as well. So sometimes we kind of need to see, is there anything that we could maybe profit take on or exit the position to try to actually have capital for new positions. After we talk about the management of the margin accounts, which will do stocks and options, then we're going to talk about some new positions as well. So the focus here today is really kind of talk about managing what you have stock and option based and kind of doing it from a kind of a checklist point of view. So let's quickly just kind of hop in and take a quick look at where the market is. Now, first off, if I take a look at this, and I'll just kind of send that back. There we go. Oh, capital outcome. Okay, now what we're going to do is let's just pull up first off SPX first, not Palantir. Don't look at Palantir, okay? Now, if we pull up, let's say the SPX, since last Monday, we've kind of been talking about collars. Occasionally, well, it's a joke. And really, if you kind of look at the SPX, it's kind of like right where it was last Monday, okay? You got to remember, a lot of stocks going into earnings. It's not unusual to kind of get some pause in prices. That does not mean everything. When you look at the NASDAQ and say, what's happening there? The NASDAQ futures last night, last night was a late night, 2:30, okay? Finally went to bed. 7 o'clock, woke up, looked at my watch list on the NASDAQ, and then saw NVIDIA up like 8. And I was like, is this a dream? Is this NASDAQ watch list? Am I seeing that NVIDIA is up $8? And sure as it was in that NASDAQ watch list, NVIDIA up $8. Nice way to wake up in the paper money account. Now, if you also take a look at, now the one thing that we would say real quick on the NASDAQ, that actually did get above the 161 extension. That was an intranight high. If you look at the futures, now that we're looking at the cash, the NDX, that was a brand new high. So some of these tech stocks not backing down here. And there's a couple of those semiconductors. When we talk about the stocks, you're also going to see the semiconductors did punch a brand new high here today. Now, when we take a look at the Dow Jones, that's probably the one that's kind of lagging the most. The Dow Jones has been fighting to get above the 10-period moving average, and we haven't been able to. Matter of fact, this is the opposite of bullish momentum. This is bearish momentum. When the price is below the 10-period moving average and you can only go up for 3 days or less, doesn't have to be 3 days, it could be 2, it could be 1. But if you go up for 2 days and then you see a red candle, you go up for 1 day and a red candle, this is the unwinding of bullish momentum. This is the bears starting to take control, bulls not stepping in to buy, Dow Jones being a little weaker here. This is in the shorter term, almost, or is a short-term low for the last couple of days for the Dow Jones. So keep in mind, if you have some stocks in the Dow, you might be starting to get kind of some exit signals potentially, okay? Or maybe some reasons to be a little bit more cautious if we're reading the chart. Now, I'm also going to just bring up, let's kind of now just go take a quick peek at some positions. So one of the benefits of kind of coming to a class like this is we're not just talking about markets in general. We're talking about taking individual positions of stocks and options and then putting them in a sample portfolio and managing those positions. If I just sat there and talked about the markets, it could sound interesting, but show us some examples. Speaking of that, so we have 2 different accounts, right? We have the margin account and we have the IRA account. Let's start with the margin account first, then we'll work our way to the IRA. Now, the first thing that some investors like to do is they like to put their positions based upon what type of strategy they are. Now, that's just kind of, I like that, just because I don't want to look at a whole list of stocks or ticker symbols and then wonder what type of positions they are. Now, if you say, James, I don't know that you could do that. First thing what you actually need to do is if you had old layout and you just see a listing of positions, first thing you need to do to get that, go to where it says new layout. So on the right-hand side, you're going to see 3 lines. Click on it, okay, right, and I'm right there. Go to new layout. Okay, now, if you said, well, James, I have a stock like Palantir, how do I make the categorization? Okay, we're going to right-click on the position itself, the shares of the stock, in this case, of Palantir, and you might have different positions, that's fine. And what you're now going to notice is we're going to go down to where it says move to group, and yours will say add group. Now, if I said, for example, GH, Grace, okay, let's just call it a Grace. Grace is with us, okay? And I'm going to make a categorization of Grace. Click on that. Where does it go? Well, now all of a sudden, we put Palantir in the Grace folder. Okay, it's not literally a folder, but you know what I mean. Okay, now, how do I get it out of there? How do I put it back? Well, we're going to right-click on the 34 shares. We're going to move it to the group, and I'm going to put it right back in that stock section. Or I can move it to anywhere I want, okay? So we could actually just do that. Now, if I said what I'm going to do is, how do I move it up or down? Click on the 3 lines, move down, and then we could just categorize. I like to see stocks, short puts, because that could be new stock positions, covered calls, callers. I like the stock positions at the top. So that's not a bad actually way to do it. And there we go. Now what I'll do is, how do we get rid of this or rename it? Right click right there, click delete group. And now what you're going to see is it'll take that off. Now, sometimes what you're going to see is unallocated. If you have not put that in a portfolio yet, okay, we're just now going to put it back in the stock section. So that's kind of some functionality of really how to do that. Okay, that's not what I want to talk about, but I think as I'm showing you this, you might have questions. So that's why I just did that. So first thing what I want to do is, when we talk about this, I want to kind of talk about a position that's under pressure here today, to say the least. I want to take a look at NEM for just a moment, okay? Now, NEM, why are we bringing this up? Well, NEM today kind of had a pretty rough go this morning, and I haven't done anything yet. We do all the trades in class, okay? And lo and behold, this stock opens up lower and has just been selling off quite aggressively. Now, how does this relate to the paper money portfolio? Well, if we go back to the paper money portfolio, is in the margin account, what you're now going to notice is we see 100 shares of stock. The stock is down $4, and that stock position is down. Okay. Now, what you're now going to notice is we also have the short call, the 62.5, and then we also have the 55. Now, this position is collared. So if we said, hey, how bad is it today for that NEM position? So first off, when we take a look at, let's say, the position and said, well, how bad is it today? And let's look at it in terms of a dollar terms, okay? If I looked at this, and this is very important because I'm going to kind of go over some tidbits that I think are very important to kind of really understand. If we take a look at this and said, well, how bad is NEM today? NEM, the position is down $175. The shares are down $415, but the protection has offset the stock losses by about $250. Okay. So how much are we down net? $179. Now I want to kind of go over just real quick. So the margin account had a collar already before this, but the portfolio that actually did not have that, NEM, is also in the IRA account. And so have you ever been in a situation where you said, man, the stock is starting to go down, and now I'm starting to wonder if I should maybe consider, if you considered options and the collar strategy, hey, maybe I should consider protecting the position. So first thing that what we're going to do is I'm going to click on sell. This was the stop. It hasn't hit the stop yet, $54.99. We're going to right click on that, cancel the order. Step two, what we're going to do is we're going to trim the position. In real life, if someone said, I'm going to do cover calls and collars, they're probably not wanting to do 110 shares because they're trying to make like 100, 200, and so on. So what we're going to do is we're just going to trim that position just a smidge. And when I right click on that position, I'm just going to sell 10 shares of stock. Okay. And we're going to go from 110 down to 10. And then what we're going to do is say, well, how long would it take to really kind of do a collar strategy? How long would it take? Now I'm going to go to confirm and send. We're selling the 10 shares. It's going to take us to 100. So that way, when we do a cover call, sell the call, etc., it's going to be covered to having 100 shares of stock. Send the order. Now what I'm going to do is I'm going to go back to kind of the methodology, right? Picking the expiration, the strike. We've talked about 20 to 50 days to expiration. Okay. We're going to go look at the 15 August expiration. That's what we've been talking about. We're going to also talk about looking at a delta on the call side, out of the money, meaning above, with a delta of 30 to 40. If we take a look at that, that's going to be the $60 call. How many of you feel like that's not too tasking? Monthly options, starting there, looking at a strike price of delta of 30 to 40, out of the money, so that way there is some upside potential. And then on the put side, looking at the same thing, a delta of 30 to 40. Now, a lot of times, if we did this, how do you actually put a collar on if you already own the stock? Simple. Right click on the bid of the option that you want to sell for the call. Right click, sell, and collar. Now, James, when the investor saw that stock dropping down pretty aggressively, do they have to wait to a webcast? No, they could trade on their own, okay? So, I mean, I saw it 90 minutes ago, just kind of falling down pretty aggressively. Did not hit the stop, but how long does it take to actually put a collar on? Not very long. Now, if we do this, what we need to understand is the delta right now is 100, okay? So what it's going to do is if we have a delta of 100, it's going to push us to the left, okay? Now, if you go to the left and you get a delta net of about 30, are you more bullish or sensitive to trend, or are you less bullish? Well, if your delta is less or smaller, you're not as sensitive to direction. Why do you not want to be a sensitive direction? You don't like the trend, okay? You're saying, look, we're neutral at best. We haven't broken support, but the trend is neutral at best. Now, what we're going to do is when when we right click on the bid of this, we cannot assume when we right click and go sell and then go to collar synthetic it's going to come up with the 60 call and the 60 put. The problem with that is we need to change the put to the 55, and then we get the debit or the credit. This is a slight debit. Most of our examples have a slight credit, and what you're now going to notice is confirm and send. Now, if this was assigned, what does that assigned mean? Simple. If we have 100 shares of stock in the paper money account and we agree to sell the shares for 60, someone can take the shares at 60. Well, that's not that bad because the stock's at 56. Okay. So a lot of investors would say, you can have it. I'll even send it to you with a bow on it. Okay. Now, if we take a look, I don't think you could do that, but anyway, you know what I meant. Now, if you look at this, notice the commission as well. So the total cost of that collar explicitly is we're actually really talking about $33. Okay, now that's not $3,300. That's literally $33.30. We're going to send the order, and now what we want to kind of watch is what does the delta now go to? We're kind of thinking that delta will be right around the 30-ish figure. Now, so we talked about a position that had the collar on it, but then in the other account, we didn't have one. And the stock actually falls, and then we're kind of questioning, how do you put on a collar after, like you see a stock starting to drop? How long does it take? Okay. Now, if this does not fill in the first 2-3 minutes, I'm going to come in here and kind of maybe move the price a little bit. And it looks like it went up about 6 cents or so. And I'm going to try to get that filled. And what I'm really trying to see is what does the delta now become? Okay. Now, I want to also just go to just real quick. So when you look at that, I said the delta would become about 30. It's about 27. Remember, that delta is telling us if the stock goes up $1, approximately net, the position would be up about $27 for every $1, well, for the first dollar movement of the stock up. If the stock went down $1, the sensitivity to price movement. If the stock went down $1, the position should be approximately down about $27 for the first dollar movement. Okay. Now, how many of you in your life have ever seen your stocks drop and you sat there maybe like I did, deer in headlights, and said, maybe putting on protection is going to take too long? And I think based on this example, we probably can't say that anymore. Now, why would the investor put the protection on? The answer is because the stock hasn't really broke support, but it's definitely right down at that point. Okay. Now, what I want to do is I want to go back to just real quick, kind of talk about, like, when I'm looking at a collar example, what are some of the questions that go through my mind in managing the position? Now, this is very important we kind of do this because we've been talking about this, and the reason why we've been talking about the collar strategy, it's a bullish strategy, but we're also trying to be kind of careful around and on earnings, okay, which we're going into. So that's why we're talking about it. Now, when we look at a collar position, we see hood, ticker symbol, 100 shares of stock, and we look at the 110 call and the 90, okay? So I want you to listen very specifically to what I'm saying now, okay? So when we actually look at a collar position, we are really looking at where's the short call. We got 110 and write it down on a sheet of paper, and we got the 90 put. That's the short call. This is the long put. Great. Now what? Well, we're saying where is the stock in relationship to those strikes? Answer? Well, we're right in the middle. Okay. Now, what does that kind of tell us? If we're at the $100, we're in the middle. What does that tell us? Do we have to panic? Oh my God. No, we don't have to panic. We're in between the short call and the long put. Okay? Dead center. Where can we see that? We're right at 99.5, right there. So first off, I want to know, listen to the question. I want to know where's the stock in relationship to the option strikes. Okay? If we are dead middle, we probably don't need to do a whole lot. Why? Well, because we're in the middle. Okay? It's not like we're pressuring the upside strike or the downside at all. We're dead center. Now, number two, what's the length? How long have you been in this trade? We talked about yesterday, if you've been in this trade maybe 9 or 10 trading days, the investor might set a buyback for the long put. I didn't say that, okay? We talked about if we've been in this trade 9 or 10 trading days, the investor might set an exit for the short call if the stock broke through resistance. So if we actually pull this trade up and said, hey, when I look at this trade and say, how long have we been in this trade? And we say, well, this trade was just put on yesterday. We're not setting a buyback for the short call because we haven't been in this trade 9 or 10 trading days, okay? We want to kind of let the stock consolidate a little bit and play itself out. So that's the second. So the first question was, where's the stock in relationship to the strikes? Okay. Second question is, how long have we been in this trade? That will then determine, is the investor going to set a buyback above resistance by 1 to 2% for the short call? And we haven't been there, so I don't have anything to do. Now, we're gonna double check, do we need to actually buy the call back or roll the position, I should say. And that's what I wanted to say. Can we roll the call? What type of percentages would you want to get if, for example, we actually saw the short call could be rolled? Well, the answer would be, do we have 50, 65, 80% of the max gain? And if we look at this and said, look, we sold it for 505 and it's at 475, we don't have 50, 65, 80% of the maximum gain. There's nothing to do. If we did, we could actually try to roll the call, okay? Now, the fourth question that we ask ourselves is the days to expiration. Are we getting inside 4 to 10 days to expiration? And the answer is no, okay? I don't have anything to do. So repeat, what's the first question? Where's the stock in relationship to the strikes? If we're dead center, we're thinking we don't have anything to do. Now, second question, what's the length of the collar? The reason why that question is important is because if we've been in there for about 2 weeks, about 10 trading days, the investor might say, where's the resistance? I'm going to set a buyback for the call. Third question, is there an opportunity to roll the short call if the investor has 50, 65, 80%? So a lot of times you could roll the short call, but that typically means that the stock that position has been on there for a while and there's been some time decay. And that fourth question is, are we inside 4 to 10 days to expiration? And we repeat that over and over and over again, okay? Now, what I want to also do is just kind of come down to just this real quick. When we take a look at, let's say, Boeing, okay, and this can be really important because we're now running out of time. Speaking of 4 to 10 days to expiration, we have the 210 put and we have the 200. Where's the stock in relationship to the short put strike, which is the bullish side of the trade? Now, let's go back to setup for just a moment, application settings, and we're going to go to where it says positions, okay? And we're going to put this as percent open. Now, remember, we talk about this 50, 65, 80%, okay? And Boeing, what you're now going to notice, is at 99%. Now, I know what you're thinking, James, but I want that last piece of sauce or that last sauce off those ribs, and I want to just grab that last 0.7%. Well, the problem is you're $20 above that short strike, and now you're risking what the investor made and the max loss. And when you logically think that through, that might be the most foolish thing. Now, we might say the last famous words, there's no way the stock could go down. And if you trade long enough, those are going to be probably the words you wish you would have never said. So what we're going to do is we're going to right click on that. We're going to create closing order and we're going to buy that back. And now the investor, if we can buy that back for 5 cents or less, should be commission less to buy that short option back. What we're going to do is going to send that. Now, this is very important that we're doing this. And you're going to also see why is it important we're going to do it? Because we're only trying to trade the amount of money that's in the account. We only have $1,200 to work with. I need to get some capital back so we can put some new positions on. Now we're going to see some little three letters here, ITM, in the money. Now you tend to see that on the week of expiration. Now if I click on the AXP, what do we got here? We got the 305 call, we're long, okay, and we got the 310. Where's the stock in relationship to those strikes? What do you want to see for a long call vertical? Answer. Well, you'd like to see the stock above both strikes. Now, stock is down $7 here today. So this is kind of what happens here where you start taking it below 4 days to expiration, and all of a sudden the stock kind of starts going the wrong direction. And now you say, well, what should I do now? No, you don't. We don't get it. Okay. Once you come inside 4 days, there's no magic show here. You have run out of time. Now, if we would have gotten out yesterday and got out at 4 days to expiration, the Monday of the week of expiration, if you go inside 3 days, 2 days, 1 day, you are playing a very dangerous game of you hope, you wish the stock is going to go in your intended direction. But if it starts going against you, you start losing chunks of gains and you don't have the time to get it back. So we could say, well, I could have been up more yesterday. Yeah, if we follow the rule set. Okay, we're going to right click on this, create closing order, going to sell it. Now, I know I wish I could have been up more if I just sold it yesterday. Okay, confirm and send. And what we're now going to do is note the commission, send that. Now, what we're now going to see, now, by the way, we got mobile devices. You got Thinkorswim Mobile on your phones, Samsung devices, Apples, whatever you got. You also got tablets. Don't tell me you're so busy. Okay, I don't believe it. I got 4 kids, a dog. I got more stuff going on. I don't have days off. Okay, so don't tell me you're too busy. Okay, I don't believe it. Now, if the biggest actually thing is, we also want to take a look at the Amazon. Amazon, if we take a look at that, we have 2 different expirations. We got the July expiration, the 210, 215 call. On a long call vertical, what do you want to have happen? You want to have the stock above that short call. You want to have the stock above both strike prices. The most famous question we've asked here today is, where is the stock at in relationship to those strikes? Well, on a long call vertical, we want that stock price going to be above both strikes. It is. Well, what percentage are we at? We're pretty much at maximum gain. Now, a lot of times as people, we love being right. And we just like looking at this and saying, you know what? Let me tell you how smart I am. Let me tell you how right I am. And I like looking at those gains. Look, these are unrealized gains until it's sold. So we don't care about being smart. I don't know anything, and I'm fine with that. I know very, very little, and I'm completely fine with that. So I don't care about being smart. I care about getting the potential money and stuffing it back in the portfolio and grabbing those gains, okay? It's not about feeling smart. It's about were you able to capture any of those gains. Right click, create closing order, and we're going to sell it. And now what you're now going to notice is we're going to, it's already at the mid price, confirm send, and we're going to note the commission, send the order. Now, if we take a look at this, we need to double check something real quick, okay? Now, this is a question for you. We have 30 days to expiration, right? We always talk about if the investor can get 50%, listen, okay? We can get 50% in the first 10 trading days. That's like an 80% return. That's huge, okay? Or if we can get 65% and there's more than 20 days remaining to expiration. Are we at 65%? The answer is no, okay? Now the question we're gonna ask ourselves is, do we have 50% in the first 10 trading days? And the last question is 80% ever. Well, we're not at 80%. So that question doesn't matter. The second question of 65% doesn't matter. The only question that really matters is, and this is very important, I'm doing this here today, when you manage, you got to ask yourself, what are the important questions to help me guide my decision making? So I'm going to go to the first question. Do we have 50% in the first 10 trading days? I don't know. We're about ready to find out. When we actually click on this, we say, okay, has this been 10 in the first 10 trading days? Well, it looks like it was June 30th. When we say 10 days, are we talking about calendar days? Are we talking about trading days? And the answer is we're talking about trading days. So we're going to go to the chart and say, where's that June 30th? It was right there. I'm going to put a little cursor right there. And all I'm going to do is I'm going to draw a line from where we were to where it is now. And I'm going to say, have we been or are we at 10 trading days? So in that little rectangle, it's going to say 15 calendar days, 11 bars. The 11 bars are every candle or a bar. That's the trading days. Now, yesterday, what you're going to notice is we were pretty much at the same level that we are today. What does that probably tell us? If we said, look, we're so focused and said the first 10 trading days, could someone have probably had 50% on that position in the first 10 trading days? And the answer is ding, 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 probably. Now, let me ask you a question. As traders, do you think this trend could continue? Why is that question important? Well, because if you think this trend could continue, the investor might try to profit take on the current position and then set up a new position. What we just said right there is we're going to roll the position. That's a fancy way of just saying profit take or exit and then establish a new position. Now, let's show how we're going to do this together, okay? We're going to right-click on those lines. We're going to try to grab that 50-ish%. Now, what we're now going to do is we're going to buy it back, okay? Now, this is just me, okay? We're all different, and sometimes people like to kind of be just, I want to get out of what we have now. We'll just right-click on the position, create the closing order. Confirm and send, note the commission, send it. Now, we don't want to assume, we want to verify, did the position fill in the first 2-3 minutes? So I'm going to kind of notice that it has not filled, keyword is yet. Now, what I'm going to do is I'm going to go to the 15 August, the same expiration, and what we're going to do, there's still some time remaining, and we're going to say, look, could we look to maybe do another put spread? Well, if we went over here to the put side, remember, if you're doing a put spread, short put spread, trade fills. If we did a short put spread, the investor is trying to trade more probability. They're trying to have a position that's a little bit more forgiving, meaning that the break even is lower typically than a long call vertical. Now, what I'm going to do is we're going to go look at selling the put with a delta 30 to 40. Okay. Now, guys and gals, what we're talking about here today, management, this is what real investors are doing. They're actually getting experience through paper trading. And then what they do is from that paper trading, they learn of what are questions by the strategy that are important to managing the position. And they're yes or no answers. Okay. That's how I like to think about it. Okay. Now, what I'm going to do is I'm going to right click on this, sell, going to go right back to vertical. So the short call that short put that we're selling is the 220. That if we look at liquidity, we could see that there over to the right-hand side, 9,000 contracts. We're buying the 215, and then it goes back to just classic position sizing, okay? Well, if we're sitting in a portfolio about 34,000, and we say, look, I don't want to risk any more, let's say 1% of that portfolio value, well, 34,000, 1% would be $340. So what does this really mean? Well, it really means that when I look at the max loss given one contract, it is at 1% of the portfolio value. Okay? Now, it's hard to have consistency if you're never disciplined. Okay? The questions are helping guide the discipline, which is hopefully going to actually kind of create potential consistency. But if you don't have the questions, it's hard to know what to be disciplined to. Now, if we take a look at this, note the commission. So it's the credit less the commission. And now what we're going to do is send the order. Okay? Now the question for Bruce is, what of the Greeks is best to watch close to expiration of the option with a 2-cent theta? Well, so if we looked at the options and we said, hey, the theta is 2 cents, on that option, let's say if it's a single option or it's a vertical, it's just saying that option approximately is going to decay, assuming volatility stays flat. This option is going to burn approximately, theoretically, 2 cents a day. Okay? What can alter that? Bid-ask spread. What can alter that? Volatility going up. Okay? And so really, that's what that really means. Okay? Now, what I also want to do is that, so first of all, is this helpful in kind of going through some examples like this? I am going to say one more, and I'm going to go to new positions. One of the stocks, and let's kind of ask ourselves the questions again, okay? So when I look at this, what type of trade is this? It's a long call vertical. Question number one, do we have 50% in 10 trading days? I don't know. Let's find out. When was the trade put on? This trade was put on June 26th. This is going to be outside 10 trading days. Now, let me kind of show you a quick variation of this. When you have a spread, if it's a long call vertical, it's a short put vertical, when we talk about the percentages are the percentages. But that does not necessarily mean the investor has to be blind to where resistance or a target is. So first off, if we kind of said, okay, do we have 50% in 10 days? We got 51%, but it's outside 10 days. The goal here would be that if we're outside the 10 days of the first 10 trading days, the goal would be 65%. So if we did this trade and said, okay, what is the max? What is that? Well, we paid $15.95 for the call. We paid that. We collected $10.95 for the short call. So the debit was $5. That was the debit. Now, if the debit was $5, then what's the maximum gain? Well, if you got a $10 wide spread, the maximum gain would be $5. So if we take a look at this, we're trying to say, how can we actually maybe set up an order to actually buy that back for 65% less, okay? Where we actually see the gains are sitting at, in this case, 65% of that maximum gain. We're not there yet. Now we can visually watch that. But the point I want to kind of make on Caterpillar is when someone is actually in a spread and they notice, they say, hey, James, we're up near an area of resistance. I would like 65%. Well, sometimes you might say, well, James, I'm up near an area of resistance where sometimes investors sell. Well, if they're up near an area where investors sell, you might say, I want 65%. I have over 50, but this is an area where some investors might try to exit the position. And sometimes when we start to see a loss of momentum, we start to see that MACD go down. Today, the MACD has finally gone into the red. And you might say, well, James, normally I like to get a little bit more, but I'm going to try to sell up near the area of resistance. Now, the investor could also kind of do like a reward to risk ratio on the option price. They could just set a target price, or a target percent, which we talked about, or they might just say, look, I'm just going to manually exit this now. Let's show that, okay? I know we like a little bit more, but if the investor says, look, I'm up near the area of resistance, and it's up near that percentage I like to get anyway, I'm going to right-click on that, sell. Now, remember something, selling is a part of the process. We are not buy and mold, okay? We're not trying to collect stuff, okay? We're trying to get in something, exit the position, and see is there difference in those values and try to grab the gains, okay? Now, we know people like to collect stuff because if you look at people's garages, they're full, okay? A lot of them are full, okay? That's not what we're trying to do here. Now, what you're now going to notice is credit less the commission, send the order. Now, we got about 5 minutes left, okay? So what I want to do in this case is let's kind of talk about, are there any new examples? We had to do that because we didn't have any money left, okay? Now, I want to talk about one stock just real quick. Historically, SMCI had been a stock that had an accounting irregularity, and it brought into question their historical financials. Man, what we just said right there, investors are like, wait, I don't even know with what you stated, is it real? Okay. Auditors come in, they verify the accounts, they verify the transactions, which takes a long time. Okay. Now, that's been a while ago. All of a sudden, one of the stocks has been kind of trying to come up a little bit and squirting, the keyword squirting, above the area of resistance is SMCI. Now, a lot of you say, well, James, these stocks are great, but man, you always pick these bigger dollar stocks. Let's look at a smaller dollar stock. Let's also look at a smaller dollar stock that actually has a little volatility as well. Go to the trade tab. Now, when we look at the trade tab, what we're going to notice on SMCI is that implied volatility is juicy. Now, when we look at the implied volatility, just because it's higher does not mean it's better. It means it's more risky. It could go up or down. Now, when we take a look at this, if we went to the 15th August, 31 days to expiration, the annualized implied volatility is 86%. Mama mia, okay? When we look at the dollar movement from now to expiration, it's 11, okay? It's $11 up or $11 down. Gosh, $11 on a $53 stock? That's like 20% from now to expiration. Now, what happens is if they're forecasting that much of a move, they might be saying, hey, look, we're going to increase the option premiums for that potential price movement. Now, when we talk about selling options, we tend to talk about Delta 30-40. We're going to go to the lower end of this. And what we're going to do is we're going to sell the 49, which has a delta of 31. We're going to right click on that bid right there. Now, when we talk about, well, what about downside protection? How do we know this? What if the stock actually starts going down? What some investors might try to do is they might try to buy a put below as a way to define the risk. Not saying it's going to have a great chance to close below it, but they're just trying to define the risk. What we're going to do in this case is we're going to buy a put. There's a whole bunch of them with a delta less than 10 that are liquid currently, and we're just going to pick one. Now, if we sold that, let's say the 49, and we bought, let's say the 36, we can now see what that maximum loss is going to be. Now, again, I said before, do we think the stock is really going to close below 36? Very low probability, but a low probability doesn't mean it can't happen. Now, if we take a look at this, there's the credit. What is this trade really? When you widen the strikes out like this, what is the investor trying to do? This is really a cash secured put. And what we see in this case is we're trying to really get the credit. What's the break even? Well, we know we're obligated, the investor is obligated to buy the shares at the strike price from the time the trade is placed until expiration, not just expiration. The credit on that trade, 240. The break even and expiration is 46.60. That means the stock can go down about almost $7 and be at break even. The max loss, if the stock were to close below both strikes, 1,060, a defined risk. And now what you're going to notice is there's the commission right there. So what I'm going to do is in closing here is I'm going to take SMCI in the paper money account. We're going to right click on that 49. We're going to put it in the paper money, that margin account. And we actually said what, the 36? And we want to make sure that trade fills in the paper money account. That's exactly what we showed before. And what I'm now going to do is go confirm and send. And then there's the commission. Now, a couple other stocks we want to keep an eye on. We've talked about Hood over the last couple days, Coin, okay? Other stocks we're going to keep an eye on is NEE, N-E-E, and also AMAT, okay? Those are some of the stocks we're going to kind of keep an eye on. Today's focus was really about management. The questions or takeaway from today's session is, when you manage positions, what questions are you asking yourself to guide your decision-making and your emotions? And if you don't have those parameters, then it kind of falls apart and you don't feel as confident. So that's what we want to really do today, is talk about management and what questions you ask yourself as you manage to guide decision-making, to increase confidence, to create the discipline, and also curb emotion. Now, remember, coming up next, we have Cameron May that will be doing the class on covered calls and cash secured puts. Thank you, Connie, and thanks to all of you. Remember, with what we discussed here today, it was done for example and illustrative purposes only. And also remember that all investing involves risk. Be mindful of that risk. And this has been the class on the Investing Master Series. Subscribe to our YouTube channel and follow us also on X as well. Thank you so much. Stay tuned for Cameron coming up next. Bye-bye.